Here is your cash flow. Net income, net cash provided, free cash flow, operating cash flow. These last three columns, I like these ones the most.
Yeah. Do you see if you hover around those bar charts, it can show us how they have been growing also. Just a visual graphic presentation. Yes.
All these ones. Yeah, it can have a nice showing up. So can you check their operating cash flow and then their capital expenditure?
There's a question.
Yes, what is it?
Mulif is asking, what does the retained earnings imply?
Okay, retained earnings, right? Let's say we are saying the company have an earnings per year of 9 billion, right? This is the total profit that we have for 9 billion.
After
right?
tax.
After tax. We said with 9 billion, in this particular case, actually 2018, 19, they had a profit of 3 billion. Let's say they have a profit of 3 billion after tax, right? And then we said, okay, fine, we are paying 1 billion as dividends.
So then
right?
they retain 2 billion.
So 3 minus 1, which is going to investors as dividends, we are left with that, 2 billion. That 2 billion is going back into the business to be reinvested. Right? Those are called retained earnings.
Okay.
So these are the money that this is actually the money that the business the profit that the business retain inside actually in order to finance future growth. Right? If they want to acquire new companies, if they want to expand new territories and open new branches, they use that money. So these guys, they've got a very good retention in the business.
So how is it related to the free cash flow?
Now, I wanted to get this name. Now, how does it relate to the free cash flow?
Yes.
Now, retained earnings is almost the same as operating cash flow, right? So operating cash flow is the total amount of money. 2.8 is the total amount of money that we have, right, as a business.
Okay.
And then we said now we need 4.24 as capital expenditure. This is the amount of money that we are going to use to refinance business growth, to refinance our operations.
Can you hover around the free cash flow that you're looking at so that everyone can see?
Okay. So this one.
Yes.
So we had an operating cash flow of 2.8.
Crash now.
Right? And then we've got capital expenditure for 424, right? So capital expenditure is the total amount of money required to finance the business, to sustain its growth.
Okay.
So guys, let me do this, right? Let me say I'm running a business. I'm just gonna explain this concept. I'm running a business, right? Like I'm running a delivery business, for example, right? I make a profit at the end of the year, right? But I make a profit of like 1 million, right? That's my total profit. On that total profit, I pay my shareholders dividends for 300,000. How much am I left with?
Did you pay a what?
So 1 million my profit, I left my dividends is 300,000. How much am I left with?
You're If you pay 1 million profit and then you pay 300,000, you are left with
Yeah,
100,000.
700,000. And then in 700,000, now I said, okay, next year I actually want to buy one more extra truck to increase my revenue.
Okay.
Or the truck that I was using this year is getting old. Let me get a new truck. I'm going to subtract 200,000 more. Then I buy a new truck. How much am I left with?
400,000.
Right, 400,000. Actually, it's 700,000. 700 minus 200,
Oh,
700,000.
you said, I
So,
thought you said 3.
or three. Okay, I said 200,000. So now it becomes 400,000. That's 400,000 is free cash flow. This is a month that I have as a business to do whatever I want to do now.
Okay.
So capital expenditure is actually amount of money that you actually spend as a business in order for us to drive next year's growth and next year's revenue and to expand growth in something like that. That's why business with high profits but high capital expenditure are not good businesses. Because what does it mean? You always need more money for you to generate more money. Are you with me there?
Yes, sir.
Yeah. So um, this business you actually need the reasonable amount of money for it to generate more money. It, literally, the capital expenditure is quite very low compared to your free cash flow, and they left with a lot of free cash flow. So free cash flow, this amount of money that you can use if you want to do free acquisition, and if you want to test your expansion, you can use this 204.33. This one, this last month, which is very important figure, by the way, to look at when you're doing carbon analysis.
And it has been increasing.
It has been increasing over the years.
Johan is asking, what does it mean with the expenditure decreasing compared with previous years? So what does that mean?
So you see, there's a year that in 2016, the one that they spent 1,144, right? It means that this year Mr. Price was aggressive. If you go into the financial statement, it's either they did an acquisition or they're opening more stores, right, around the globe. Probably they're opening new stores in another country, or they're opening new stores in another province, or they actually increase their footprint all over. So it means they have to increase their logistic cars, they have to increase their, um, um, their inventory or something like that. So this year, it's a year that actually the business was expanding. You see,
Okay.
yeah. So then the next year you might expand, but not as much as you did the previous year. So which means right now capital expenditure is becoming low because they are not seeing enough opportunities to reinvest or to expand in other regions or to buy other businesses.
Okay.
Yeah. So it might be an indication for that. Or it might also be an indication that for that it is now becoming cheaper and cheaper to operate, right?
Okay.
The business, right? For if I was delivering you using a truck, the truck was costing 200,000. Now the same truck now the following year is costing you 20,000. It means now my reinvested capital becomes less. It only becomes 20,000. Do you get it?
Yeah.
Yeah. So it becomes more cheaper and cheaper. And if you can look at, let me just look at 2016. If you look at 2016, you see there was a big jump also in their inventory from 2015 to 2016. You can look here. There was a huge jump, you see, than other years, which means they're increasing stores. They were literally opening new stores or and buying new stocks or something like that.
Yeah, even the property under non-current assets, it also jumped.
Property, none, okay. Yeah, The property also jumped. You see, it means this is,
Yeah, 2016 and 2017, it was jumping.
yeah, it jumped by literally like 1 billion. You see,
Yeah.
it's
So
quite a lot of money. So which means they were expanding. They were actually aggressively growing their business. And then the following, they said, no, let's not spend too much. And then now they're stabilizing. They said, okay, I think we are over saturating the market. Let's not spend too much money in expansion. Let's chill. That explains why their capital expenditure is actually decreasing.
So I want to know, what other parameters would you use in order to determine a fair value price?
So, in determining a fair value price, we've got many methods. One of them that we haven't looked at is called discounted cash flow, whereby you project future cash flow, then you discount them back to today's value. So there are many different methods depending on the nature of the business
Okay.
and the industry and the business operating. You see, but remember, you can calculate the fair price, and then you also test. Right now, we see that the cash flow for this business is good. We saw that, right? It's good enough. The balance sheet is good, right? The income statement, though it's not increasing that much now in revenue and profits, it gave some difficulties between in 2017, 2018, but it's generally doing good as a business. So now we certify that all the statements are actually at a better position. And the pricing, we saw that the pricing for Mr. Price is a bit cheaper, right? Now, it's up to us to think about in the future, what do you think? Is, is the business good business or bad business?
Okay, that's for us to decide.
That's for us to decide. But you can literally see that if you buy this business in the next 10 years or in the next 5 years, you won't lose your money that much.
They have a lot of customers from the average class and your middle class and the other lower classes as well. So they're in a good position.
Yeah, they are. It's not a bad business. It's actually one of the best businesses to actually look into if you want to buy stocks for the long run. Their financials are speaking for themselves. Their management is on point. You see, they don't recklessly borrow money. They make sure that they spend less. And I think I like the business. I like the model, and I think it's a good. For me, it's a better business, a good business than other businesses.
So the impact of the currency, the foreign exchange, won't it be too significant? Because now I think we are at 19 rands per against the dollar, and they
Yeah,
buy their stock from China. So how will that affect them? 18 rand 80 cent.
it's gonna hammer them. It's gonna hammer them. That's why there's the impact of increasing rent. It has impact on prices, local prices.
Because I saw when they reported they were using 14 rand and it has increased significantly from what they reported using that time at that period.
So it means if these guys they're not hedging their rent like what Sasol does sometimes, né?
Okay.
There's increase in cost.
All right. So
Increase in
hedging,
cost.
how does hedging work? How would they hedge to
So
mitigate their losses?
that's another lecture for another day now. Because hedging now you are literally saying that I want to always buy my rent at 14 rands.
Okay.
Yeah, that's what you're trying to do. You're stabilizing your exchange rate to 14 rands. So if you hedge, even if the currency changes, but yours is not gonna change. You hedged it I, 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 ahead of time.
Because it
So
seems
it's
like if companies don't do that, especially if they deal with foreign trade, they
yeah.
get hammered significantly. Because if you check, Sasol also had the same problem, but I will discuss it on another lecture, I think.
Yeah, so if you don't hedge, you're gonna be in problem. Like these guys, if they're buying product in China now at this rate, and they want to buy US dollars and use those US dollars to buy products in China. And if they don't hedge that exchange, right now they now need 19 rands just to buy $1.
So how
Right?
do we know if they are hedged? Do they disclose such information to the public?
If you go through their financial statement, they will explain it if they are hedged or not. If they're not hedged, you see the impact on their shops. They increase prices.
So now there will no longer be 50 rand t-shirts. That's bad.
No, they will not have 50 rand t-shirt. The t-shirt will increase, Baba.
Okay.
So, which means the weakening of the currency is becoming a problem, especially if you are relying too much on imports.
Yeah, that is bad.
Which is very, very bad. By the way, I think we extended our lecture now. I don't know if you have any questions from the other guys, they can ask. Before we close, any questions, any contributions? I don't know why their mics are not working.
I think Mulif's mic is working now.
Mulif, any questions?
I have a question, Super.
Any contribution?
One question. I just wanted to ask, in terms of the debt equity ratio, is there a relationship between debt equity ratio and shareholders return?
Debt equity and what in shareholders return?
Shareholders return is.
You say debt equity ratio and shareholders return.
Yeah, I wanted to ask, is there a relationship between the two? More especially if you're determining which company to choose.
I think you are asking the relationship between debt to equity and return on equity.
Equity, yeah, so that's the one.
Return on equity.
Yes.
Yeah, there is a relationship. But you see, let me explain you a very simple concept, right?
Okay.
So it depends on the nature of the business, right? In some businesses, debt to equity ratio is very important to see if the business being financed by debt or it's being financed more for equity, right? Usually,
Okay.
you don't want a business with high gearing ratio whereby you've got too much debt compared to equity, which means the business can go bankrupt if things go haywire, right? Even if you've got a higher return, but if there's a high debt equity to debt ratio, debt to equity ratio is a problem. If the business is more debt than equity, it's a problem. Particularly in some industries, it means that in the financial crisis, if you can't pay that debt, what happens? You're filing for liquidation. So for me, those kind of businesses, they're very tricky. Don't play around that area. But there are some cases whereby a company can have high debt, low equity, but it can have high returns on investment capital because they are using that debt to generate more money for their investors, which is a bit tricky because it only works when the environment is good. But when the environment goes bad, when the business can't pay back their debt now, it becomes a problem. I don't know if I answered your question.
Yes, you've answered. I do understand now.
Sorry?
I do get it now.
Yeah.
I do understand.
So
yes.
There's some relationship, but it's another thing that you need to sit down and really explain in detail. It's quite a lot of things happening between those two ratios. What else is the question?
Okay, there's a question relating to current supply problems due to coronavirus and uncertainty in the stock market. How can invest time okay, let me just read it. How can invest time the best? Okay, what is the best time to buy Mr. Price shares? I think that's the question.
This one is very difficult, Brad, because I don't want to relate to people how to buy, when to buy, but you see, no one knows well when is the company's really at the bottoming. So, but if you calculate if you can see right now, many companies are really hammered by the market. They're a bit cheap. So wait for this thing to really be over. When you see that things are starting to pick up, then I think it would be the right time for you to actually start buying. Or you can even buy right now and use average buying. If the company go down, keep on buying, you see. But as we see from Mr. Price, if you've invested few years, would make money, but it's a good business. Fundamentally, it's a good business. The reason why it was like that before, the business was really overpriced. But right now, the business is actually fairly priced. Right now, it's fairly priced. So you can wait for it to be even more cheaper. You buy. Then, yeah.
So yeah,
It's up to you. That's your own analysis, but it's a good business.
what I'm getting from this is that there are chances that it might get cheaper than the way it is now.
Yeah, the chance that might get cheaper.
Okay.
Yeah.
So patience is virtue.
Patience is virtue. Because right now it's almost fairly priced. So you need to get it cheaper. You know, when get cheaper you buy, it's gonna go back up there. But this Mr. Price is a resilient business.
Okay, I think we have extended our lesson to more than the time that we had anticipated to spend. So I think we can just stop here, unless if you have any other thing to say or if anyone has something else. Jet.
Yes.
I think we can stop here.
Yeah, me, I'm fine. I'm happy. I think I'm good enough.
Okay, I just want to do a bit of survey while we're still here. So I'm just gonna cut this video at this end. So I want to know from you guys, who is using their own data, and please tell me how much data did you use after the video so that I can be able to give a feedback to everyone who would like to enter the meeting, but they want to know how they're gonna spend for it. So just tell me the amount of data that you used for this session. Is that okay?
Okay, no problem.
I used 53 megabytes.
You used 53 megabytes. Okay.
Yeah.
Awesome.
I'll get back to you.
Okay, you can send it to me via WhatsApp. It's fine.
Okay.
All right. All right. Thank you guys for participating. We will have another session on tomorrow, right?